Hello ladies and gentlemen, I'm Joseph Novichkov, the Senior Trading Manager for GDM. Welcome to today's webinar, as this is the second part of the main webinar, which is Advanced Trading the Trend Techniques. Today's webinar will focus on ranging market, or the so-called sideways trend. Now, as we took a look last week, we spoke about uptrend and downtrend, how to advancedly take steps in order to find better entries and exits. In today's webinar, you will find out how to trade the sideways trend after a current directional trend has been depleted. Now, the chart you see in front of you is the Euro-USD daily chart. As I mentioned, let me mention it one more time, all of the webinars this month are connected one to each other. Later into the session I will remind you about the rest of the webinars, what the topics are and what we will focus on. As you know, as to those that have been here since the beginning of this type of connected strategy one to each other, is that we are focusing on mid to long-term trading based on the fact that when you have an existing trend, especially on a daily chart, it can continue for as long as a month or 2 months, maybe even 3 months and more. Basically, this gives you an opportunity for multiple entries in one direction in order to benefit as much as possible from the market. Today's presentation, as I mentioned, will focus on ranging market. We will be using additional tools and indicators to find better entries and exits, and of course to rule the type of trading so we can stay on the safe side. First of all, I would of course plot those indicators that first we used in our previous webinar. That was the first part of Advanced Trading the Trend Techniques. Since we've been using the Relative Strength Index, as I mentioned one more time for those that haven't been here, the levels here are just the default levels of 30 and 70. Also the application to close with a period of 5. This is extremely important to remember, especially on mid to long-term trading. What we've been using the last time was also the 14-period exponential moving average. Right now, we're going to, of course, swap it for Bollinger Bands, as basically because we will be trading the sideways range. Therefore, Bollinger Bands will act accordingly. I will remind you one more time that when the market is in identified uptrend or a downtrend, we will witness that Bollinger Bands, Relative Strength Index, and other type of oscillators, they don't really react on the market. They stay oversold and overbought for as long as the trend is over. That is why Bollinger Bands is extremely good to use, especially with a ranging market, because not only because we have the same type of moving average, which is the 14 period, but because the upper and lower level of the Bollinger Bands will react on the price action. There is an additional type of setup right now that we're going to use, a little bit different from the definition that we've been using the Bollinger Bands with a deviation. So let's take a look at the indicator first. It's been presetted, as you can see, from the time periods that the strategy has been tested. We will be using the period of 20. And the last time we've been aligning everything in time for a period of 14, smaller time periods for multiple price action, and of course multiple position availability. The deviation here on the larger time frame, we'll be using deviation of 3. Deviation of 2, regardless of the type of deviation, which was 3 The last time we've been aligning, as you remember, with the technical indicators. The relative strength index was a period of 4. Right now we're using period of 5. The smaller the better for larger time frames to gain better access to the market. Deviation of 2, basically because of the bigger time frame that we're looking at the chart, we need smaller deviation because of the market fluctuation. Now you will see on your own how it acts on the chart. Let's apply it directly. There you go. You can see here that the Bollinger Bands are reacting well on the upper and lower levels. So pretty much on deviation of 2, the price stays within the range and reacts very well with the moving average here. Some of you already noticed the last time we've been talking about the relative strength index, its power to the 14-period exponential moving average. Right now we're swapping it for 20 exponential. It's extremely important because it's a bit slower, but with the other indicators that we're going to use later, we'll make better entries and exits. One thing here before we proceed, just to remind you from the last time, that when we're trading the directional trend, uptrend or downtrend, we need to see the relative strength index to stay in overbought and oversold conditions for as long as the trend is active. Once it crosses above those levels, or below the level of 70, we have a change in trend, or the so-called sideways trend, which is the main topic of today, ranging market. It's extremely important to remember that during a sideways range, the one that we have here, the relative strength index acts extremely well on the level of 70 and the level of 30. That's why we're not using those other customized levels, extreme oversold on 20, extreme overbought on 80, and the additional levels of 40, 50, and 60 from where you're getting your triggers. This is a better application to smaller time frames, such as 30 minutes, 1 hour, 4 hour charts. It's much better because it gives you a better overview on the short-term market. Right now we don't really care much about those daily fluctuations, as per day we're seeing only one candle, and if you're looking at a daily chart, a bit more. However, daily chart is preferred. So let me get you a little bit more familiar with the next indicator that we will be using right now in combination with everything else that you see on the chart. We will be taking a look at Stochastic Oscillator. Now, some of you might already know what the Stochastic Oscillator does and what shows you on the chart. However, let me get you a little bit more familiar with a little bit of history about it. The developer is George Lane in the late 1950s. Now, the Stochastic Oscillator is a momentum indicator that shows the location of the close relative to the high-low range over a set number of periods. Now, why are we talking about the relative to the high-low range? This is extremely important because the sideways range trading is the so-called swing trading technique. We will not be focusing on larger time frames such as daily to weekly chart, which we might be able to combine. You will see in the next webinars we will be talking about Elliot waves. In combination with stochastic indicator gives you a better recognition of those waves and their counts, where it's ending and where new waves is beginning. This will be taking a look at in our following webinars, Elliot waves. Now, talking about the Stochastic Oscillator. According to an interview with Mr. Lane, the Stochastic Oscillator doesn't follow the price. It doesn't follow the volume or anything like that. It follows the speed or the momentum of price. As a rule, the momentum changes direction before the price. So what tells us is as such bullish and bearish divergence in the stochastic oscillator can be used to forecast reversals. Okay, this is extremely important. This was the first and the most important signal that Mr. Lane identified. He also used this oscillator to identify bull and bear setup to anticipate a future reversal. Because the stochastic oscillator is range bound, is also useful to identify overbought and oversold levels, such as the relative strength index. That's why in a combination those two form a powerful tool for you to use on the market, especially on a sideways range. Now, before we proceed with a little more details about the stochastic, we will shrink this relative strength a bit, because we're going to use stochastic oscillator here. As you can see, I've been using it recently. Extremely important now here for the levels. And the default settings for the stochastic oscillator is 14 periods, which can be days, weeks, months, or an intraday time frame, for example. I'm not going to go deeper into the formulas or the K period and D periods. We will face that further on into the presentation. Let's see those periods that we need to use so we can connect it all together, and future presentations, future webinars will be connected to those periods. Now, they've been customized only to match the exact other indicators, so we can get a signal for entry and exit at the right time. We needed to have a aligned time frame, timeline. That's extremely important. Especially on the sideways range, those two indicators, stochastic and relative strength, gives you extremely powerful movement of entry. Combined with Bollinger Bands, as we mentioned, it reacts well on the upper and lower band, especially when the market is ranging. This gives you a third confirmation, giving you more than 60–70% of certainty that the price will go your way. As I mentioned, additional indicators will apply to gain more percentage of certainty. This will follow in our next presentations. Bit by bit, we will be taking a look at every time, basically because those presentations, ladies and gentlemen, here are a little bit more extended into time. Therefore, question and answering sessions will not apply after the session. Therefore, whatever questions you have, don't hold them in, just shoot away straight away, so I can go ahead and answer every question once it comes through. For whatever questions might jump in, you will be having that opportunity at the end of the month. We will have a seminar webinar, which is question and answering. You will have the opportunity to ask questions, whether for the strategy itself or any other thing that is related to the financial markets, your type of experience, whether it's a psychology of trading or anything else. We will be able to answer each and every one of your questions. The periods here that you see, customized period for K period is 5, for D period is 3, and of course for the slowing is also 3. The levels are on the stochastic here, as you can see, overbought and oversold 20 and 80. They apply as by default. This is how it looks on the chart. As you can see, where you point it, you will find out which one is which. Basically, you have one which is the stochastic and one which is the signal. The red is actually the signal, telling you when the price is changing direction and what you can expect. Just simply put, before I get into a little bit more details on the interpretation of this oscillator, we need to have one alignment here and here and here to have our signal in one time frame. As you can see, this is just a brief, brief interpretation of it. As you can see over here, here, and here, we have a signal to the upside. Quite a bit of long side of pips here. However, just a slight interpretation about this. Later we will use additional tool to measure those retracements on those waves from where we can gain access. The stochastic oscillator measures the level of the close relative to the high-low range over a given period of time. Let's assume that the highest high equals, let's say 110, the lowest equals 100, and the close equals at 108. The high-low range is 10, which is the denomination in the percentage K formula. The close less the lowest low equals 8, which is the numerator 8, divided by 10 equals 0.8 or 80%. If we multiply this number by 100 to find the KK percent would equal 30. In the close, that was at 103, or 0.3 by 100. Now that might sound a little bit too complicated. That is why we're not really going to focus in those details about the formulas, how the stochastic is actually measuring those levels. We will jump straight into overbought and oversold. Now, as we know, as a bound oscillator with boundaries of 20 and 80, the stochastic makes it easy to identify overbought and oversold levels. The oscillator ranges from 0 to 100, of course, as you can see from the chart here. No matter how fast the price advances or declines, the stochastic will always fluctuate within this range. Traditional settings use 80 as an overbought threshold and 20 as an oversold threshold. As you can see here, we are using the default settings by it. Now, before we look at some chart examples, how we're going to trade this, it's very important to know that overbought readings are not necessarily bearish. The price can become overbought and remain overbought during a strong uptrend, or vice versa for the downtrend. This is something that you need to remember, guys. So when we have an identified up or downtrend, stochastic and relative strength, also Bollinger Bands, they do not apply. Over there, as we mentioned the last time, you use different indicators. Right now, we will focus on a range which clearly we have an uptrend from here, point A to point B over here. Now, as we have already a trend, which however makes a new low here, which is lower than the previous low, which is over here, tells us that clearly the trend is over. If you measure it with a, the very easy way to measure whether the trend is reversing to a sideways or downtrend is just to draw a straight line between this and this point, so you can gain better perspective. However, for a trained eye, we don't really need to do so to find out that the trend is clearly over here. Therefore, we're connecting Fibonacci retracement from the lowest low point here, which is the shadow, to the highest high point here, which is also the shadow. Now, what we will have is a definition between the 0 and the 66% range. Those customized levels on the Fibonacci retracement, they stay from our basic teachings, because those levels, 33, 66, are extremely important. Now, what we see here is that 33 we will be using as a trigger point to the upside or to the downside. Aligning together, of course, with the relative strength and the stochastic in time to gain perspective of where the price is going. Even one of those signs fail, also the Bollinger Bands, at least one to fail. In percentage, our certainty that the price will go in a direction that we are already determining is falling. Therefore, we need them all to confirm. Such confirmation we have, as we mentioned, this is a swing type trading strategy. We have a definition between the 0 and the 66. Now, why we do that? Basically, if we have such movements, price excursions or hikes above the 0 level and below the 66 level, we can consider that from this trend here is going to continue to the upside if it breaks above the 0 level. And it's going to change in a downtrend, you will see in the future, when the price breaks below the 66. Not the 50, the 66. Now, some traders, more of a risky traders, what they do is to buy when the price is at or close the 66 range and close it when the price are at or close to the 0 range. This is one of the ways. One that we have over here, extremely well performed, upper side of the Bollinger Band, strong bullish candles to the downside, confirmation on the relative strength, additional hike to the downside from the stochastic. However, it's not in overbought conditions to suggest further downside. Therefore, it could be a bit more of an aggressive type of trading here. As you can see here, the price only touches the 50 level and bounces back up to the exponential moving average here before the price excursions up to the upper range of the Bollinger Band, and then also goes down to the 66. So these kinds of places where we have little confirmation on the chart, it's better not to trade it. So basically what now I will focus on is the most certain, and that is the absolute alignment on all charts. On all indicators on the chart. And that means as we will be taking point A here as a time frame. Now what we have, let me just get rid of the whole drawings here and just put a timeline on this candlestick where it touches and closes above the lower band of the Bollinger Bands. What we have aligned in time, as you can see, lower range here on the Bollinger Bands, touching the 66, overbought, oversold conditions on the relative strength, oversold conditions on the stochastic. All we need to see is a bounce above those levels here. This is the level of importance from where you should wait to see a bounce off. For the very simple reason is that if we do not have a break above those oversold conditions here on the relative strength and on the stochastic, we might expect the price to stay in oversold conditions for the entire period of the new established trend, which in this case could be a downtrend. So this is your confirmation here. We'll mark with C as a confirmation that the price will move to the upside so we can gain entry to the market. It's very simple. Aligned in time, we have multiple candlesticks closing above the 66 level of retracement on the Fibonacci, giving us an opportunity to buy this instrument over here, enter the market with whatever lots your account allows you to, and hold it as long as the price touches the 0 level here, so you can close that position. Why we close it? Very important. Let's put another vertical line here. We can have a little bit of mixed data. Relative strength is somewhere around oversold conditions. We have already reached the 0 level here. Stochastic is not anywhere near the overbought conditions. Basically, from here, what we can expect is a halt of the price for some time before it moves to the upside. On the other hand, this is a great opportunity to exit the market because you have a mixed signal from your indicators. This is the best way to exit the market. Whatever is mixed, you have a position, get out of the market, collect your profit, and wait for another entry. And this is only one currency pair, ladies and gentlemen, that you can see. We have so many commodities, indices. It applies to everything based on the fact that we're trading mainly on a daily chart. And if we have to sum it up by measuring our entry, let's say we enter somewhere here on the opening of this candle, we exit on the closing after this one on the opening, 239 pips for about 20 days. Now trading with one lot, this is $2,390 of profit for 20 days, and this is only one lot trading on one currency pair. Bear in mind that if you have 10 lots, that's 20,000. If you're trading with 100 lots, that's 200,000. So it really depends on how big your account is, really depends on how your account allows you to enter the market and what is the amount of money that you can allow yourself to risk in such a period of time. That is why this particular type of trading is suitable for accounts at least above 10,000. I'm not saying that small accounts cannot trade it, but please be cautious. Based on the fact that when the price is making fluctuations below here, sometimes the price is retracing back to the same level. You might get scared and either close your position and then it's going to bounce off to the upside, and you have to catch a worse entry with a higher price, for a smaller profit. Or it's just going to shake a little bit your psychology, and therefore in those kind of times people tend to lose money. That's why I have to remind you, that's why our first main topic of this month's webinars was the psychology of trading. Extremely important for one trader to be successful in the market. That's actually a good point to remind you here that if somebody missed that or any other webinars, as well as you know that everything is connected, please go to our YouTube channel, find those webinars and review them one more time in your convenient time. As well as this webinar today will be recorded, sorry, it's already recorded, but it will be uploaded in our YouTube channel as soon as we moderate it a little bit. So what I'm actually trying to show you here is, let's erase everything, let's skip a little bit forward to see what will happen if the price goes above or below those levels. Now, as I mentioned, when the price breaks below the 66 level, as the one we have here, multiple confirmation with the daily closes below the 66, we can expect a change in trend or to the upside. Now in these cases, these are extreme market conditions that tells us these are only fakes. Therefore, I wouldn't be trading in this kind of condition. I would, you might be buying the price here, but you can see that it's going back down here. Those are market situations that we can't really avoid in any time. We can only rely on those indicators to give us entries and exits. So basically, we have to rely on something that will give us a higher percent of certainty, therefore alignment in time with all indicators. That's the best way to trade. If you have a fail in even one, it will decrease your certainty on the market. Now let's take a look further what happens here. After the price breaks below the 66, we have a current already ready established downtrend on this particular pair. For as long as this price is going down, the relative strength stays oversold for as long as the trend is over, and as you can see in overbought conditions, it never ever reaches it. It only does in those areas where the price makes an excursion more than 66 or at 66%, which if we have to measure from here to here, this should be the 33% level, close to the 50 level, which is making the trend a bit more flat. And over here we still have a new sideways range formed. As you can see, the price is staying within the range of the stochastic and the relative strength. Over here you can see here here, and here, for how long time those indicators are staying within oversold area. And that's why those indicators are not accurate, especially on an existing up or down trend. Many times I've been mentioning about our my ability to trade the sideways range. It's extremely comfortable to have an existing down or uptrend. You have multiple positions, you have nothing to worry about, you just buy or just sell at multiple points availability. But when the sideways range happens, people tend to lose money because they think that the market will reverse. Well, it doesn't necessarily do that. It needs to fluctuate in a range before it continues the trend or shifts the trend in a reversed direction. In the sideways range, you have multiple opportunities for short time frame to make a lot of money. Let's get back to our chart, our existing time frame here. What we have is opportunity number 1 here, opportunity number 2 here, with a close over here. You know that the price is not breaching below. You have another second opportunity to buy again or sell here and close it here. That's why those ranges are acting as buy and sell points within the very short time frame existing trend. As you can see, this is an uptrend on the short time frame. This one is a midterm trend. This one is the secondary short-term trend. So basically, those types of trends that you have to identify in small time frames or larger time frames helps you in all the way through your trading. Even though if you have to enter a position from here, you still have your exits on multiple points here and here. One entry here as well, exit here, another entry here to the upside. So that's why using those levels will help you identify which direction the price will go. However, there is an additional indicator that will help you to determine that direction. We will talk about it the next time. We will need a little bit more time to discuss that, to see how to interpret its movements, its indications. Basically, because we will put on top of everything that you see right now, additional indicator that will help you determine price direction. Another thing that we must use at all times, something that we should never forget, something that I deliberately did not place on the chart. Nobody actually prompted me for it, which is not a surprise, but still, the 200 exponential moving average. It's very important. Every trader is looking at it. As you can see, there it is. Beautiful, beautiful entry. However, in small or big time frames, when you have the price crossing or intersecting in some way with the 200 exponential moving average, especially in an identified up or down trend, it signals that the price will be moving sideways for some period of time until it identifies. This thing uptrend, then trend we're reading the sideways. So if we shift to to the weekly chart, we can see that this range is a little bit higher, and nothing actually corresponds well with the because on the 4-hour chart what you can see is further fluctuation, especially on the relative strength and the stochastic. Now, if you are going to use smaller time frames, you will need to change everything on this chart, every single detail on those different indicators that you're using. And that's going to need a lot of time to do it, so you can backtest it to see whether it's working. The main focus is on the daily chart for mid to long term trading. It gives you very accurate signals. It doesn't really matter if you are looking for a big profit of above 100,000 US dollars per position, or 2 or 3. It's not really necessary for you to enter the market in the next 3 months when you don't have a position. You're just waiting for the right moment to come. As some traders are saying, for the price to ripe in order to enter the market at the right moment. Now, as I promised the first time, we saw that we've been doing everything the same on multiple currency pairs or commodities in some cases. So what we will take a look at right now, let's take a look at our favorite cable. There were a lot of people wanting to see all that. First of all, we're going to clear a lot of these indicators that were placed. However, there's something that we can actually do. In order to save that, as you already know, we can just save it as a template. We're going to call it like this. The next time we go to the pound, we're just going to select the template, and it's ready for us to use. What do we have here? Present days GBP USD. We're looking at a daily chart. Let's identify what's happening here. Now, we know we have a established downtrend already, and it's actually going to continue for quite a while, we're expecting, as well as the slump with more than 100 pips for the past 50 minutes, something like that. Let's find this sideways range and identify those entries. We have a clear sideways range established here, but we don't really know that until we see the price closing lower than the previous low here, as we mentioned the first time. In that case, we will use our Fibonacci retracement to measure this distance between the higher high and the lower low of this range. As you can see, the price is staying clearly inside the range of the Bollinger Bands without making unnecessary excursions as this one. Extreme market conditions here as well. That's why the settings of those Bollinger Bands, there it is one more time, 20 with deviation of 2 for those that just came into the webinar. Another thing, let's identify what those indicators are doing. We have over here the price staying somewhere in oversold, in overbought conditions on all indicators. Okay, we have already established a type of low, low, and high, high. We know that every time the price touches the zero level, we can short. We have our confirmation from the relative strength. Again, the period of 5, a different type of setup for those that just came into the market. The setup for stochastic 533 for those that just came in. And of course, we have it confirmation here breaking below the overbought conditions of 80 at one at the same time aligned here. And our exit, one more time, the Bollinger Bands, close to it, going in oversold conditions here and here, on a breakthrough, giving us another opportunity to buy the instrument. But this is our close, and of course automatically we can buy the same instrument. So you can see from a range of how many days, let's say from here until here we get the confirmation, 10 days, 342 pips. Another one, if you're buying here and you're closing here below the moving average, another one, 167 pips for 3 days. Now just calculated with one lot, ladies and gentlemen, it's extremely easy to find out how much money you would have made on these entries if you've been using this particular setup. We can see the price bouncing below here, going to our initial entry, and if you still have your entry and you still haven't closed it and it didn't hit your stop loss, which in particular you can set it up below the 33 level, you will still have the opportunity up till here, 342 pips. Personally, what you see in this moment is a little bit of false signal. Relative strength is way below the overbought conditions. The trigger here, both triggers, the stochastic and the signal, are not above overbought conditions. So this is another hint telling you that you can still hold on to this, or just open a new long position on this one and close it someplace around here when the Bollinger Bands is touched, when your price is close to the zero level and everything is in overbought conditions. This is the extremely easiest way to trade on the daily chart, swing trading type of strategy. Another thing, you can see that the price is breaking above this level. You already have a long position. Another very important here, don't be greedy. Don't let the price, don't let the market surprise you. As you can see from our previous example on the Euro-USD, we saw the excursion here with a false signal and then it break down. So even if you gain a few more pips here, that's going to be only once, twice, 3 times, but the next 5 to 10 times you will probably lose your money by trusting those fakes. Trade the range. Those boundaries are giving you an absolute entry, beautiful entries and exits. Trust the relative strength in the stochastic on the sideways range. Do not trust them on an existing up or down trend. One more time, extremely important thing here. Now let's continue forward. Let's check out what the price is doing after this range is already broken. So everything we saw back here as an example is not valid. The price is staying above this place here. So we clearly have a uptrend developed where from this point here to this point here you draw a line and you will see where it goes. But still, it's not going to be that accurate. You will have to use the trend following techniques we spoke about the last time. Use the 14 exponential moving average, will give you better entries. Check out at which level stochastic, the relative strength is staying. In this case, it's not really staying too much on oversold or overbought conditions, giving you a clear example of how uncertain the market is at this point. And clearly it's over somewhere here, changing in direction heavily, exactly at the same place at the 33 retracement. That's why when you have something drawn on the chart, that's something as a technique for long-term type of market analysis. You know, those indicators that you've placed, you know, key points of entries and exits, just mark them with a horizontal line, like this one here, for example. You already know that the 33 level is extremely important. There are too many lines with the Fibonacci, so you're just going to use one line, and this is this line, telling you that if it breaks below the 33, which is already a major support line, you can see that it bounced off from here. That was, when, 4 days ago. That's a range of 151 pips on one lot is $1,500. Now if you're trading with a major account, that's still a lot of money. However, if it breaks below this level, you're fully aware that the price is going to make a major excursion with more than 100 or 200 pips. So this is just a hint, something extremely important, you know, something as a recommendation, something that I'm usually doing. I just keep those lines as long as it's possible, as long as the chart gets too crowded, and then you start getting rid of those levels that already weakened. And that's going to happen in a few months, maybe a year time. Now, I have charts that have support and resistance levels for so many months from the beginning of this year, and they still act as a strong support and resistance level. So that's something that can tell you that you can rely on those levels to get them as targets or stop loss levels or take profit levels. So it's by your own choosing. However, this example also proves how well we can trade the sideways range. Let's take a look at another example here. We already took the cable and the Euro USD as an example. Should we say USD JPY? Somebody said here USD JPY as a recommendation. If you just have, ladies and gentlemen, any kind of a currency pair or any kind of instrument that it's a favorite to you, and you want to get an example right here, right now, what this strategy will provide you for this particular pair that you want to test, just put it into the chat below, and I will be able to give it as an example. Some of you already got proactive. A few minutes ago I saw, can I have an example with USD JPY? Of course you can. Not a problem whatsoever. Let's use the same template we already did, sideways range template. There it is, present days here is what we have. Now as you can see here, the range of the Japanese yen, we just get rid of those lines that we actually got as a template from the beginning. The sideways, there is no sideways range basically here. Pretty much, yeah, we'll get to gold. Thank you for the example. Actually, I had it in mind, but we will set that up as well. We'll take a look at some other quotes in addition. That will be a definite instrument that we need to see as an example. As you can see, the trend of the Japanese yen clearly ended somewhere here. However, immediately it turned into a short down trend. So basically, in those kinds of conditions that you have an uptrend, it immediately turns into a downtrend. That only gives you an idea that the trend in a major scale is not over and it's going to continue. So if we have to use just a simple trend line, as we normally do, we'll have to take it from this point here and to this one. In a larger time frame, time scale, you will see that this particular trend line to be broken is extremely forward in time. That's why when we were using the 14 exponential and the rest of the setup as we saw the last time, I'm not going to repeat it, we will give you a better entry point from the moving average and the price bounce off to tell you from better entries and exits, based on the fact that if you have to rely on this trend line, a bounce from it will happen in a very long time, based on the fact that we're looking on a daily chart. Even if you're looking at a smaller time frame, this particular trend line will still be there at the same angle, and it will still say the very same thing. So in those cases, those are the moments when a certain economy is changing so rapidly, and the exchange of the currency against the greenback, for example, is happening instant. So basically the trend is changing into a downtrend and then into an uptrend immediately after it's over. So basically we don't have a sideways range here in this particular moment. We only have an identified up and down trend. So what you need to do in this case is trade the trend. That's why still on this pair, let's take an example. We will shift the chart a little bit in the past to see how the price is developed, see what's happening. As you can see, clear uptrend. Let's measure it to see how much and where it goes to the higher high. The price stays within the range above the 66 level, which definitely tells us we have swing technique up to happen. We will be using the Bollinger Bands as guides to give us entries. Here, here, here. Exit here, here, and here. With another entry, if you wish. With an exit. Or here, or you just wait until it gets in overbought conditions here and here, along with the Bollinger Bands. So basically this particular place here gives you an early indication that you might exit half or a portion of your position just to secure your profits and set up your stop loss somewhere a few pips below the lowest point of this candlestick to protect your past performance from here to here. Still, you will not lose anything. You will still be making money, a little bit less if you've been exiting here, but you are staying in for the big treat, for the exit on the upper range of the Bollinger Band. Sooner or later, the price will go to that range. It's either going to reverse down here, or it's either going to go to the upper level. And as you can see, as a guideline, the moving average is telling you when the price clearly breaks the range, so you can keep an eye, because anytime soon, in the next day or two, you will have an exit signal. Well, that's about in what time frame let's measure. We have entry here somewhere, exit, let's say you waited and see what's going to happen. Conservative type, 145 pips here in 6 days. Let's say you didn't manage to enter at the very same moment. You entered here, you exit here, 241 pips in about 13 days. So basically that's more than 1,000 pips in a month of a possibility. What better example would you like to have, ladies and gentlemen, in how beautiful the sideways trend will give you profits in your accounts. Sometimes it's that's why it's my favorite, because in most cases it gives me more profit than an existing trend, for example. Because you're holding off to a position, you're adding additional positions with smaller, okay, you say today prices retreated, let's say, with that much percentage from the yesterday's close. You know, if you are a bit more advanced in education, if you have a bigger brain that you can store a bit more information and recall past price closes that you can do by observing the chart, of course. But if you're observing 30 charts, for example, that would be difficult to do. You know, you will have to remember something. So in this kind of range here, in less than a month, you're making about 500 to 600 pips of profit in only 2-3 positions. Well, I wouldn't need to enter more than that when I'm making 50,000 a month, for example, or 100,000 a month. It depends on your account size. So this is a good example. And now let's go and focus on the gold price. Let's see what gold does with our technique. We'll use the same template as we did, only to wipe out everything we have so far here. So let's take a look at present days to see what the price is doing. Well, there it is. We have some kind of an uptrend here, okay? Mid-term, short-term, bouncing off from the 200 exponential, as I said, extremely important to observe. From there, either the trend changes to the opposite side, or when it breaks it, it just goes and goes to the same direction with the full force. Let's measure and put this Fibonacci retracement. The price here stays within the range above the 66 retracement. So what I'm trying to tell you, earlier, there were a few questions about those levels. You were asking, why am I using level of 33 and 00 to trade some, in certain range, and then on some places I'm taking 66 and 0. Now, that's a very good question, by the way. I didn't said that previous, but now I have the chance. It really depends on how liquid and how volatile a currency pair or any kind of instrument is. So if it's extremely volatile, as the gold, for example, or the GBP USD or the euro dollar, those kinds of quotes are traded mostly on a daily basis. Therefore, their liquidity and volatility will be bigger than any other, giving you an opportunity for a bigger profit. But that doesn't matter if you're trading less liquid or less volatile pairs. You can still use that particular strategy, but then you will need to use the smaller levels. That's why you will see between which levels the range is convened. All right. Here it clearly, over here the trend is over. You can see it's over here, telling you breaking below, going in a sideways range for a very short period of time, just a few days, changing to the downside, hitting the 66, giving you an entry. You can either exit on any point where you see resistance, or just use those indicators here and here. This one is telling you further upside is possible. The price yet again bounces one more time a few days after from the 66%, giving you additional entry opportunity. And then the price hits overbought conditions and it goes to the upper level of the Bollinger Bands and still continues in a sideways range. As you can see, the price fluctuates between oversold and overbought conditions extremely fast, but it doesn't really correspond well with the other indicators. It's not anywhere close to those Bollinger Bands, right? Relative strength is not telling you that it's on overbought and oversold conditions. Only the stochastic is telling you that, but you can't really define your answers on only one indicator. You need them all. Therefore, you're staying away from it, and you can see the price range from here and here is extremely small. Well, not small if you're taking is the example of golds, because you can see gold changes here with $83, which is about $8,000 on a lot trading. However, we're after the big money, so basically we need 14 days, $195 of gold price change is a pretty good profit. So that's how this particular system you can use to trade the sideways range. Most cases people will actually say that this is a little bit too complicated, or maybe you can't really trust this range. Well, that's why you have the indicators. If you cannot trust yourself, trust the indicators. You need to have a clear view. You need to have a clear confirmation of what the price is doing, and mostly, but not least, very important, you need to identify which direction the trend is, whether it's upway, downwards, or sideways. This is extremely important. That's why everything is connected. And how to identify that direction, extremely easy. I will tell you the next time we meet. For now, it's about 1 up to 2 minutes past the hour. We have a little bit of news coming out. I saw that right now the pound is actually trying to break below those levels. It recently broke, as you can see here, from This very tight range of shadows here, just a few pips below, that's about 10 pips down. I'm already about $300 on profit on this position when I entered earlier. Just not to give you any wrong ideas, just you have to consider that I'm a bit of an aggressive trader, so I have quite a bit of cash at my disposal to allow myself to trade a bit more aggressively, especially when I have a clear picture of what the market is doing. So once the price breaks below that red line, we can expect further downside. We can see on the weekly chart, for example, how far it could go. Well, the first stop is somewhere around here. That's in about 67 to 70 pips of the distance, and the next major resistance, support is seen somewhere around this level. That's 173 pips, around 1.5620, an average of price for the pound against the dollar. So this is just a brief explanation of what we see. Also, as a confirmation, we have some negative news came from UK based on the fact that the dollar is strengthening every day and the pound is weakening along with the European economy. We can, of course, expect further downside for the euro, for the pound, and for any other European currency that you're trading. But enough with the deviation on market analysis here. So this would actually put today's webinar at its end. And I will meet you the next Wednesday for our next webinar. This would be the Advanced Find the Direction webinar, where we're going to talk about these additional indicators that you might use to better determine at which direction the market is going to go. And this is not going to be the last part of this webinars that are connected together. We will have additional find the right strategy techniques, and of course the question and answering seminar. But before that, in the middle, I just gave it like a little bit of break to present Elliot wave theory, something that you can use to make your technical analysis a bit more easier, to bring it on a bit more advanced level, and most of all to look at the market at a bigger picture and to be aware of what might come on the market as a formation, as a wave, as a new establishment. We will be talking about this not next week but the week after. Therefore, today's webinar is concluded. Thanks everybody for joining in. Whatever questions you might have in addition, if I have the time, just send it over in my email. I will regard a bit of time to answer that. Of course, if you think you will be able to forget those questions, just write them down on a piece of paper. And 26th of November, the last webinar is question and answering seminar, where you can live on the webinar for everyone to hear your question or your opinion about the company, about the market, about your experience, or anything else that you want to share. You will have the time over there. Thanks everybody for joining in. Have a beautiful rest of the trading day. Bye-bye.